Silver just printed an all-time high at $83.62. And 5 minutes later, the internet started whispering the scariest sentence in this whole market: Comex registered is zero. Now, breathe, because I'm not here to throw gasoline on a rumor. I'm here to tell you why that rumor even exists, why it keeps resurfacing, and why a move into the $80 zone is the exact moment paper silver collides with real-world limits. Tonight is not a normal price went up night. Tonight is the kind of night where a chart stops feeling like a chart and starts feeling like a receipt you're not sure you can cash. Because silver is not just a precious metal trade anymore. It's wiring, it's solder, it's solar, it's electrification. It's the quiet ingredient inside modern life that nobody talks about until the shelves get thin. And when a metal like that rips to a number that looks unreal, when we're talking about silver flirting with the low 80s, there's one question that suddenly matters more than every YouTube thumbnail and every Twitter victory lap. Can the market actually find metal at this price without breaking the bridge between paper and deliverable? That's the theme of this video. Not doom, not fantasy, not they're out of silver tomorrow. The theme is, when price goes vertical, the system gets tested. And the system doesn't get tested in your candle chart. It gets tested in the boring places: warehouses, warrants, delivery rules, settlement windows, and who is willing to part with real bars when everybody else is chasing exposure. So let's start with what just happened on the screen. Silver didn't just grind higher, it sprinted. It pushed through the 70s, then the market did that thing it always does at extremes. It got quiet for a second, and then it jumped. That's not magic. That's what happens when liquidity thins and buyers hit the tape. And when silver prints a fresh high in the 83 area, the entire market gets forced into a new conversation. Because the higher the price goes, the more people start asking, is this still a trading story? Or is this becoming an availability story? That's the moment the phrase paper silver shows up. And I want to define paper silver in plain, normal words. Paper silver is not fake. It's not a scam just because it's paper. It's simply a claim. It's a contract. It's exposure. It's a promise that, in most cases, gets netted, offset, rolled, and settled without anyone ever touching a bar. That's why paper markets are huge. They're efficient. They're fast. They allow hedging and price discovery. But they have one quiet assumption baked into them. If enough people demand real delivery at once, the bridge to physical can handle it. Most of the time, that assumption holds. Because most of the time, people don't actually want the bar. They want the exposure, they want the bet, they want the hedge, they want to be in the move. But in moments like this, when silver is screaming higher and industrial demand is not a theoretical story, some people start wanting the bar. And when even a small percentage of a massive paper market starts thinking in physical terms, the system gets tense. Now, about the rumor, Comex registered is zero. Here's what I'm going to say carefully. You should treat that phrase like a fire alarm, not like a gospel verse. A fire alarm can be triggered by a real fire, or by smoke, or by someone burning toast, but you don't ignore it just because it might be toast. You check the hallway, and yes, before you ask, official warehouse stock sheets exist, and they don't read like, the world has zero silver. So treat the rumor like an alarm, not a verdict, because the reason that rumor spreads is simple. Registered inventory is the closest thing the public has to a visible, deliverable shelf. It's the part of the warehouse system people point at and say, that's what can be delivered against contracts. So when price goes vertical, everyone starts staring at that shelf like it's the last bottle of water in a desert. And that's how you get the drama. Here's the first truth you need to own. A registered number moving lower can mean stress, but it doesn't automatically mean the world has no silver. It can also mean something more subtle and sometimes more important. Owners are choosing not to put their metal on the deliverable shelf. Think about that for a second. If the shelf is empty, the warehouse might still have plenty of metal in the back room, but nobody is posting it with a for sale sign. Nobody is volunteering it to be delivered at the current terms. And when that behavior shows up at the same time price is exploding, it changes the psychology of the entire market. Because suddenly the story isn't, is silver going up? The story becomes, who's actually willing to sell real metal into this, and at what price? That question is where paper markets start feeling fragile. Not because paper is evil, because paper relies on confidence that the bridge works. Picture you're at an airport. The screen says your flight is on time. That's the paper market, that's the quote. But then you walk to the gate and the line is chaos and the staff is whispering and the plane isn't there. That's the physical market. Most of the time, the screen and the gate match. When they don't match, people start acting different. They start rushing, they start calling, they start paying for upgrades, they start trying to cut the line. That's what happens when silver goes into the 80s and the deliverable conversation heats up. Everyone suddenly wants to know, am I holding a ticket or am I holding a seat? And that brings us to the real reason this moment matters. When a commodity becomes essential to both investment demand and industrial demand, it behaves differently than a pure store of value. Gold can go up and the world can mostly watch. Silver goes up and manufacturers start feeling it. Solar supply chains start feeling it. Electronics start feeling it. Every process that uses silver starts feeling it. So you get a market that's not just being bought by investors, it's being competed for by reality. And reality doesn't care about your chart. Reality cares about availability, lead times, and whether the next shipment exists. This is why the 83 print matters. It's not just a number, it's a stress test. It's the market asking, are we still trading a narrative, none, or are we rationing a material? And when you're near that line, rumors hit harder, because rumors are just the public's way of expressing one fear. What if the system can't deliver? Now, let's be honest, a lot of people use that fear as content. They scream default every week. They tell you the vault is empty every time price rises $2. I'm not doing that. I'm giving you the sober frame. If the registered shelf is low, or if people are refusing to make metal deliverable, the market doesn't necessarily explode in one day. It changes behavior, it changes terms, it changes premiums, it changes how far price can jump in thin liquidity. It changes how quickly shorts have to respect the tape. And most importantly, it changes the difference between price and cost. Because in a tight market, the screen price can say one thing, and the cost to actually source metal can say another thing. That's where the phrase end of paper silver comes from. Not because paper disappears, because paper stops being the whole story. Now let's talk about the word rumors again, because I want you to use your brain here, not your emotions. In markets, rumors spread fastest at the exact time people are most vulnerable. After a parabolic move, during thin liquidity, when the crowd is euphoric or terrified. So the right way to handle the registered is zero claim is not to repeat it like a chant. The right way is to ask, what would it look like if this is real stress? And what would it look like if this is just a misread, a reclassification, or a cherry-picked screenshot? Because both are possible. And the difference between smart people and loud people is this. Smart people check the official data. Loud people check the timeline. So here's what we're going to do in the next sections of this video. I'm going to explain simply what registered versus eligible actually means, why registered can drop without the vault being empty, and what signals tell you whether this move is becoming an allocation market. But before we go there, I need you to understand the emotional setup of this moment. When silver prints an all-time high in the $80 zone, the market's memories wake up. People remember the old ceilings. They remember the decades where silver couldn't hold a move. They remember every story about suppression, every story about shorts, every story about paper games. And that memory does something dangerous. It makes people trade the past. They anchor to old numbers. They anchor to old narratives. Meanwhile, the market is doing what markets always do in a new regime. It rewrites the anchor. And the first sign that the anchor is being rewritten is simple. Price starts jumping instead of walking. If you've never lived through a real commodity squeeze, this is how it feels. You go to sleep with silver in one zone. You wake up, and the first prints are in another zone. No gradual climb, no polite trend, just a repricing, because the market doesn't need your permission. If the sell side isn't there and the buy side hits the tape, the chart doesn't negotiate. It just prints. So point one is this. Silver in the 83s is not just a headline. It's a stress test of the bridge between exposure and deliverable metal. And the Comex registered is zero rumor, whether it's accurate, exaggerated, or misunderstood, is a symptom of the same thing. The crowd is starting to ask a physical question. And once the crowd starts asking physical questions, paper narratives get less powerful. All right, now we leave the internet and we go into the part that decides whether this is just a historic rally or the beginning of an allocation-style market. Because Comex registered as zero is not a magic spell. It's a misunderstanding of a very specific system. And once you understand the system, you stop getting hypnotized by screenshots and you start watching the only thing that matters. What is actually available for delivery at this price, under these terms, on this timeline. So let me start with the simplest version of what Comex is. Comex is a futures exchange. Futures are contracts. Contracts are promises with rules. Most of those promises never turn into a truck delivering bars. Most of the time, people open positions, they hedge, they roll, they close, they cash out. That's normal. That's how futures markets function. But the reason Comex matters in a moment like this is because it sits at the border between two worlds, the world of paper exposure and the world of deliverable metal. And in a stress moment, the border becomes the story. Now here's the part people confuse. Comex warehouse stocks are not one simple pile. They are generally discussed in two main categories, eligible and registered. Let me translate those in human language. Eligible means the metal meets the exchange's specifications and it's sitting inside an approved warehouse. Think of eligible as it's real, it's in the building, it passes the standard. But eligible does not automatically mean you can have it. It might be owned by someone who has no intention of delivering it to anyone. It might be sitting there like a locked, safe deposit box. It's real, but it's not on offer. Registered means something more specific. The bars are under a warrant system and are posted as deliverable against futures. Think of registered as, this is the portion that's actually in the shop window. If eligible is the warehouse, registered is the shelf with the price tag and the keys in the ignition. And now you understand why that registered is zero rumor spreads. Because if the shelf looks empty, people panic, even if the warehouse has metal. And here's the key sentence. A low registered number is often less about total supply and more about willingness. Willingness to make metal deliverable. Willingness to post it under the exchange rules. Willingness to be the seller of last resort when everyone is yelling shortage. So when you see registered drop, the correct response isn't to scream default. The correct response is to ask, is metal moving out of the building or is it simply moving off the deliverable shelf? Because those are two totally different stories. And this is where the internet gets tricked. They see a shift from registered to eligible and they call it they ran out. But in many cases, it can mean the metal is still there. The owner is just refusing to make it deliverable at current terms. That is a huge difference. Now, why would someone refuse to make it deliverable? Simple. Because when price is exploding, the market is telling you something. Your current price might not be the real clearing price for physical availability. That's when sellers get cautious. They don't want to deliver bars at a number that might be cheap relative to where physical demand is actually pulling. Or they don't want to become the target everyone runs toward when the crowd gets desperate, so they keep their bars eligible. They keep their optionality. They keep their leverage in the real world, the ability to say no. Because in a tight market, no is power. And once you see that, you start realizing why paper silver ending doesn't need a Hollywood default. It can happen as a quiet behavioral shift. Fewer people willing to deliver, more people demanding better terms, more premium pressure in real procurement, and more volatility as the screen tries to chase the real bid. Now let's talk about delivery itself, because this is the part that makes it real. When a futures contract goes toward expiration, some contracts get closed, rolled, or offset, but some holders decide they want delivery. When that happens, the exchange has procedures, delivery notices, settlement rules, specific bar forms, specific vaults, specific timelines. It's not, I want my silver today, it's a process. And that process is exactly why the market can feel fine on the screen while the physical world is getting tight. Because physical has friction, approvals, scheduling, logistics, financing, and risk limits on who can do what, when. So in a stress moment, you can get this weird gap between two truths. Truth 1, the paper market is liquid. Truth 2, the physical market is constrained. And if those truths spread apart, price does what price always does. It moves toward the real bid, not in a straight line, in jumps. Now let's address the registered hits zero claim the right way, because I don't want you repeating a rumor. I want you repeating a framework. If someone says registered is zero, there are only a few possibilities. Possibility 1, it's simply false. It's a screenshot, a misread, an outdated image, a troll, or someone cherry-picking a subcategory. Possibility 2, it's technically true in a narrow moment or for a narrow report slice, meaning registered got extremely low or briefly showed near empty in a specific view, but that does not mean eligible is zero, and it does not mean the planet is out of silver. Possibility 3, it's a real behavioral signal, meaning sellers are refusing to keep metal registered because the environment is too tight, too volatile, or too uncertain. And that third possibility is the one that actually matters, because it tells you something about the regime. It's not that metal doesn't exist. It's that metal is not freely offered under the old assumptions. That's what an allocation market is. Allocation markets don't scream out of stock every day. They just start behaving differently. Smaller buyers get slower fills, larger buyers get priority premiums, become sticky, and the screen price starts looking like a suggestion, not a guarantee. Now, I want to say something that might annoy both sides of the internet. On one side, you have people screaming, default tomorrow. On the other side, you have people saying, nothing to see here, it's all normal. Both can be wrong, because the most realistic outcome is usually in the middle. The system doesn't collapse. The system adapts, and adaptation can still mean violence for traders, because exchanges, dealers, and market makers have one job: survive. If the market gets too hot, they don't politely lose money. They change the terms. They raise margins. They tighten position limits, they widen spreads, they reduce the size they're willing to quote, they force people to prove they can fund the position. That is how markets cool without crashing. So when people ask, could Comex default, you need to understand what default even means in this context. A Hollywood default would be, no one can deliver anything, the whole exchange breaks. That's not the most common way stress shows up. Stress usually shows up as cash incentives to settle higher margin requirements, delivery becoming expensive, or slow increased volatility, and a widening gap between screen price and real procurement cost. That's the paper ending vibe, not an explosion, a behavioral shift. Now, here's the part that matters for your audience, because they need something they can watch. If you want to know whether this is a real deliverability stress story, you don't watch one number, you watch relationships. Here are the relationships that tell you the truth. Relationship 1, registered versus eligible behavior over time. Does registered refill quickly after drawdowns, or does it stay low while eligible stays high? If registered stays low and eligible stays high, that's often the market telling you the metal exists, the sellers are not volunteering. That's a tightening story. Relationship 2, delivery interest and delivery follow through. Are more people standing for delivery? Are deliveries increasing? Is the process becoming hot with higher attention? You don't need a conspiracy for that. You just need enough participants deciding they want bars, not exposure. Relationship 3, spread behavior and sudden jumps. When physical is tight, price starts moving like a stair step, not a ramp. You get gaps, you get wicks, you get how did it move that far that fast moments. That's not always manipulation. Sometimes it's just a thin book and a real bid. Relationship 4, premium behavior in the real world. This is the street level truth. If the screen price says 81, but the real procurement cost feels like 84, 85, 86, that gap is telling you the physical bid is higher than the paper impression. Now, I'm not telling you every premium post online is true. People exaggerate. But when that pattern becomes consistent across multiple sources, multiple regions, multiple dealers, that's a sign the market is changing texture. Relationship 5, the refusal signal. This one is subtle, but it's real. In tight markets, you hear phrases like limited allocation, delayed delivery, call for availability, prices subject to change, payment required to lock. Those phrases are the market admitting the shelf is thin. Now I want to give you an analogy that will stick. Think of the paper-silver market like ordering food on an app. Most days you tap a button and food shows up. That's the normal assumption. But during a storm, the app still works. The menu still shows items. The price might even look normal until you realize the drivers aren't out, or the restaurant is overwhelmed, or the supply truck didn't arrive. The app is the paper market. The kitchen and drivers are the physical market. And when silver is printing all-time highs, it's like a storm hit the whole supply chain. The menu exists, but fulfillment becomes the question. That's why registered becomes such a psychological weapon, because it feels like the one window into fulfillment. But remember, registered isn't the world's inventory. Registered is the portion currently posted for delivery under the exchange mechanism. And in a tight market, posted supply can go low not because the building is empty, but because nobody wants to be the one handing out the last plates at the buffet while the crowd is still running in. Now,